A warm welcome to all attendees joining the HSBC Securities Services webinar, India at 75, a discussion on key economic and market developments. Before we start, a little bit of housekeeping. Please submit your questions using the chat function or pass them to your HSBC Client Servicing Manager during or after the webinar. We would be delighted to answer all your questions. As part of HSBC's endeavor to decode everything that is happening in the Indian market, we are joined today by our esteemed panel of industry experts. Pranjul Bhandari, Chief Economist, HSBC India. Thank you, Pranjul, for joining us today. Our next panelist is Ravi Varanasi, Chief Business Development Officer, National Stock Exchange of India. Hi, Ravi. Welcome.
Hi.
And our next panelist is Pradeep Khanna, Managing Director, Head of Trading and Interim Head of Markets and Securities Services, HSBC India. Thank you, Pradeep, for joining in. So a recap for all of those who've joined in just now. We will start our panel discussion on India at 75 and we'll keep sufficient time for Q&A. To set the context for the discussion today, at the stroke of midnight hour, when the world sleeps, India will awake to life and freedom. India has recently celebrated its 75th Independence Day since this iconic speech at the Red Fort. We would like to hear from each of our panelists their thoughts on India at 75 and aspiration for the next 25 years. Let's start with Pranjul. Pranjul, your thoughts, please.
Yeah, that's a very sort of important question, which should have a very long answer. But, let me try to keep it short. And let me try to focus on the last few years, not the last few decades, just the last few years, what we're really seeing, what's fresh in our memory. A couple of things are good. And in a couple of places, we still have a long way to go. I think the areas which I feel good about is, generally speaking, India's decent growth rate, which, before the pandemic was about 6% per year, one of the fastest growing large economies in the world. So I think that's something to sort of feel good about. Remember that pre-1991, we had much lower growth rate. And, in the 50s, 60s, we had 3% growth rate. So 6% from that perspective is decent. That is one. The second is that, we are creating a place, particularly since 2017, for high skill exports. Be it electronics, mobile phones, and what have you, be it some specific machinery, be it drugs and pharmaceuticals, be it IT services. I think these are some high skill exports where India is gradually gaining global market share. And I think it's something to sort of feel excited about. The third area is, IT services in specific. It's come a long way. It's a leading sector in the economy. It started off as, KPOs, knowledge processing centers, about 2 decades ago. Since then, it's come a long way. It's extremely nimble. It's adapting to the demands of the day, from SaaS, software as a service, to cloud computing. I think Indian IT specialists, engineers, software developers have created a name for them across the world. And over the last year, through the whole pandemic, I think they've provided a lot of services, as many companies started working from home much more than anybody had thought in the past. After that, there's the digital revolution that we've seen in the economy. It all started with the unique identity number, the Aadhaar number, where every individual had a number they could be identified with. That, alongside bank account revolution, where every household has a bank account in India now, and mobile phone connectivity, which is spread very widely. I think there has been a big digital payments revolution. And what is exciting about this digital payments revolution is that most of it is a public good. Like the entire Aadhaar platform is a public good. It's not a private monopoly of one or two players, which could have been a concern and is a concern in some other countries. So that is something which is interesting. As an offshoot of that is the big ecosystem of startups, digital startups, which have come across a lot of themes, from e-commerce to a lot more now, also slowly getting into manufacturing. Huge entrepreneurial spirit has been unleashed. There are a lot of young people who are becoming founders, who are starting companies. There's a lot of global capital supporting them. So it's sort of come into a nice, the stars have aligned, I would say. And this is important because, at the end of the day, it was the entrepreneurial spirit that was the secret sauce of many advanced economies like the US, the Eurozone. So it's good to see that being unleashed in India. All of that with a good macro framework. We have inflation targeting, we have a fiscal deficit, which follows some rules. I know we complain a lot, but at the end of the day, look, we didn't let, our fiscal deficit blow up, like we could have, right, in the middle of a pandemic. So there are some general housekeeping macro rules we loosely adhere to. So I think all of this is good. At the same time, there's a lot which is not good. I'm going to take 2 minutes more. There's a manufacturing sector that is abysmally low. It's only 20% of India's GDP. It could have been higher. Had it been higher, it would have created far more jobs. So in a way, India jumped from being an agricultural economy to a services economy. And we completely forgot about the middle area, which was manufacturing, which could have created a lot of jobs for Indians. And, our population is so large. So that is an area which sort of upsets me, and I hope we can correct it, over time. We have a financial sector which needs a lot of reforms. It needs privatization. It needs more efficiency. It needs disinvestment. It needs smarter regulation. So I think a lot of financial sector reforms have not happened. We had many other reforms in 1991, but not really financial sector reforms. We also have to make a lot of headway in soft infrastructure, health, education, as well as hard infrastructure, bridges, roads, airports, a long way to go in all of these fronts. So a lot has been done. A lot has to be done now. And the next decade or two will bring in new challenges. I think the number one challenge which the world is now slowly realizing is climate change, and how India sort of decarbonizes and its own sort of path will be very interesting to see. I see it as an opportunity because it will be a great way to build in a green way. And once our products have a green stamp, I think we can do very well in exports, something we missed out in the last 2 decades. So, we can take it as an opportunity. Some other areas are artificial intelligence and so on and so forth, for which we'll have to be well prepared so it doesn't lead to job losses in the economy. But this is the sort of issues that I'm thinking about today, looking back and also looking forward.
Thanks a lot, Pranjal, for a very comprehensive and passionate answer. And Ravi sir, I'm going to come to you next, and it'll be difficult to top Pranjal, but you can give it a try, sir. Where is India at 75?
Yeah, thanks for inviting me for this seminar. Pranjal mentioned about GEMS stack, Jan Dhan, Aadhaar, Mobile. I think that is actually laying the foundation for a lot of good things which will happen as we go forward. A lot of things have happened already, and particularly on the payment side and all, the kind of infrastructure which we could build over the last couple of years is possibly one of the best in the world, if not the best. So there are quite a few things which are going good for India. The infrastructure side, obviously, there is a lot more which need to happen. And I'm sure the government is focusing on that side. And even the private capital is kind of is gearing up to get into the private infrastructure side. So we're seeing a significant amount of work happening in that side. The biggest area where India possibly should be focusing as we go forward, we are one of the largest consumer or producer of almost anything. So to that extent, India is in a position to kind of dictate markets as we go forward. It's a question of getting our act together. Quite a few initiatives are happening in the agricultural side, the entire logistics side. A lot of innovations are happening, agri-tech innovations and logistics side, fantastic effort is happening. So, and we have the biggest asset, which could turn out to be the biggest liability also, which is our population, the demographic dividend, which we keep talking about. If you don't manage it properly, it could become a significant problem for us as we go forward. But I think a lot of effort, both from the government as well as from the private sector, is getting channelized in that direction. And if we get our act together, I see India going forward in the next 25 years in the top 3, if not 5 economies in the world. So that's where we are. We have a lot of things going for us. Only question is getting the right mix of these things and ensuring that we are getting our act together in taking it forward. Pranjal did mention about the regulation and some of the softer sides which need to fall in place. Well, obviously, those aspects have to be taken into consideration. And I'm sure as we go forward, we have the talent here, we have the capabilities here. It's a question of channelizing the right energies into the right areas. And I'm sure we'll be able to make it to the top. Thanks.
Thank you, Ravi. So, Pradeep, your views on India at 75 and what should we do for the next 25 years, aspirations for the next 25 years?
Okay, thanks, Ashwini. Just being a markets guy, I'm just going to look back a little, and why I'm doing it is I'll tell later in my answer. When I started my career, we were a little bit short of 50 years old.
Okay.
1993. In 1991, India almost defaulted on international payment, shipped out gold, devalued the currency. When I started working around 94, 95, the rupee was at 31.37 to the dollar, where it had been for the last 2.5 to 3 years. And that's where the first major chunk of reserve building happened for India, as the RBI bought all the dollars that came in to an opening up economy. We went through the software boom of the 90s, the dot-com boom and bust, then the emerging market darling phase of the early 2000s, culminating in the global financial crisis of 2008, the pain from there. And we have now come to a phase. So again, if I look back, when I started working, the BSE Sensex was a little bit short of 10,000. It's at 60,000 today. The currency, which was at 31.37, is at about 75. My point is that whatever we may think for the next 25 years, I think we are going to guess less than what is going to actually happen. Okay. I couldn't have foreseen all this for 25 years, and I don't think we will foresee it again today. To me, when I talk to clients, what they are saying, the big benefits of the last 3, 4, 5 years, GST is right there on the top. There are a whole lot of logistics companies who have been talking through this pandemic about how GST has been such an enabler in terms of warehousing, efficiency of movement. You know, you get seamless delivery of goods now in less than 24 hours, stuff like that. The other really big one Pranjul touched upon is seamless payments, UPI and all of that, and a lot of what that has enabled. People are really excited about the dedicated freight corridor, which is slated to finish pretty quickly now. And I think all this kind of sorts us on the domestic side to become really efficient as one unified market. And I guess climate is top of mind, again, as Pranjal said. A lot of how we traditionally do things is going to change. Hopefully, our energy dependence on traditional sources and crude will also go down as we go ahead. And I just think it's an interesting phase because, even if we think that there were teething issues with some of the things happening, like we definitely did with GST, a few years into it, we are hearing about the tremendous benefits that some of these things are unlocking, right? So I would tend to think that we may stumble here and there. And I was really pleasantly surprised by Moody's switching us from negative to stable.
Yes.
We've let the fiscal deficit slip. We are not absolutely sure that the pandemic is behind us. And the fiscal deficit was always the main concern about why we might get downgraded at any moment. But Moody's has moved us from, in spite of that, has moved us back to stable. So I think there are aspects that we are getting right, and there is potential out there that the world does see, and which sometimes in our complaining, we are a little blind.
That's quite a nice rounded answer from market's perspective. Thank you, sir. We'll now move on to the next segment, which is essentially the current state of affairs. And this ties in very nicely with what Pradeep was mentioning on COVID. So Pranjul, the question for you is, it's been 18 months since the onset of COVID-19. I mean, what has been the impact of this pandemic on our Indian economy? And where do we stand with respect of our growth projection pre-COVID? And how well are we, ensuring that the momentum will continue?
Yeah, so look, great question and, very topical. Currently, I think things are looking good. A lot of the data we've been getting through September show that, PMI manufacturing, tax collection, core imports, all of these, which are signs of domestic economic recovery, are looking up, and that's good. Vaccination rates are rising also, and now we're seeing the first signs of activity pivoting from goods to services demand. For the first time last month, we saw railway passenger reservations growing faster than railway freight reservation. I think that in itself is an indicator that services is finally picking up. So, if pent-up goods demand led recovery in the last few months, pent-up services demand as vaccination picks up could lead the recovery in the next few months. So from that perspective, it's good. But the part which I don't feel very happy about is the pace of this recovery. A lot of us have some activity indicators, and most of the activity indicators, if you sort of index them to 100 in January 2020, which is right before the pandemic, it's only 5% higher than that. Now, you can see it could have been lower, but I'm seeing it could have been higher. For a country where the potential growth per year is 6%, in 2 years, all we've got is 5%. And I think that is a tad slow. So what's really slowing us? I think what's slowing us is the informal sector. And particularly about 40% of India's labor force, who I think have gotten disrupted in the pandemic. It's not the rich, it's not the large firms who've got disrupted. It's mostly these 40% informal sector workers who I think have got gravely, disrupted. And, their job losses, their income losses does feed into weaker, than otherwise demand, which I think is making the recovery a little softer than it should have been. Looking out, my sense is that the economic cost of inequality, which I just spoke about, will be a scar that the pandemic leaves behind. But thankfully, to counter that, we have two new drivers of growth that have sprouted over the last 2 years. And one is high skill exports. I touched upon it before, but through the last couple of years, a lot of our high skill exports from pharmaceuticals, drugs, mobile phone handsets to IT services have really picked up. So that's one new exciting driver. The other driver is the entire ecosystem of digital startups, tech startups, which are getting a lot of funding because of a lot of geopolitical changes as well. So looking ahead, one scar, inequality, but two drivers will sort of have a face-off. My own sense is that potential growth, which is the economist parlance of talking about the kind of growth we can achieve every single year once the base has been cleaned up and all of that. My sense is that the post-pandemic potential growth will be a bit lower than pre-pandemic potential growth. So from a 6% growth economy, we may fall down to a 5.5% economy. But these numbers are never static. Once we get a couple of good, solid reforms done, and I can speak about it later, which reforms I'll be looking for. But if we can get a few good reforms done, then we can lift back potential growth, back to 6% or even higher. That's my prognosis of the economy.
Okay, thank you. So talking about growth, Ravi sir, the Indian markets, the equity markets in particular have been buoyant. I mean, we've witnessed all-time high with the market cap crossing that of France. At this juncture, what are the key trends that you from NSE are observing in terms of, increasing interest from like retail investors, the domestic increase in large fintech IPOs, etc.? So what are the trends that you're observing in this growth?
India has always been a retail-dominated market, but it has changed fairly dramatically from the time pandemic, March 2020 onwards. In the last, say, 1.5 years period, we have added close to 1.65 crore new investors. It's a fairly significant addition. It's almost a 50% increase in the number of investor registrations which we have seen compared to what we had pre-pandemic. And the investor additions are coming from places which are not traditional. In fact, close to about 2/3 of total additions are coming from beyond top 100 cities. So we are seeing a significant uptake of markets from across the country. That is one good indicator. The second, obviously, is the use of technology. Pre-pandemic, possibly the mobile and internet-based trading, where investors were accessing the market directly through the broker front ends, but not through a manual interface. That number has gone from close to about 20 to now close to 40s. So the numbers have increased dramatically. So a lot of investors are using mobile and internet connectivities to access the markets. And brokerages are also supplying significantly sophisticated tools on their to their investors, and that possibly is helping us helping the investors to come into the market with a lot more confidence than what they were having earlier. In fact, we did a survey of some of these new investors in the last 3-4 months. The kind of sense we are getting is this cohort of investors is significantly more confident than previous set of cohort of investors, and they're far more knowledgeable, and they have the skill sets that are required to be in the market, and they know what they are doing, and they are confident of doing what they have to do. So that is a fairly refreshing insight which we've got through the market survey which we have done of the new investors. On the other hand, overall participation levels, while the number of investors have increased significantly, even the contribution of non-prop, non-institutional variety has gone up to close to 60%, which is all-time high. So again, we are seeing a significant contribution, not just in the numbers, but in terms of activity also, we are seeing a fairly marked rise in the activity. All over the place. Earlier, once the demand side is getting addressed, we are also seeing a fantastic improvement in the supply side. So we are seeing new IPOs coming in, particularly from the tech sector. Earlier, most of them were actually trying to get listed outside India, but I'm sure most of them have changed their tack, and then most of them are lining up for getting listed in India. And some of the responses which the recent IPOs have seen is quite kind of mind-boggling, and we are expecting significantly large issues, including LIC, to hit the market in the next about a year. The markets are very, very exciting, and the next couple of years are going to be a period to watch, both in terms of the demand and supply side, but also in terms of product availability. Now we have a wide variety of products which are available under a single roof, and investors possibly can pick and choose what they want, the kind of investment tools, investment vehicles which suit their risk profile. And I think the next few years are going to be exceedingly exciting for market participants.
Indeed, sir, exciting times ahead in the Indian equities. Moving on from Indian equities to currency, Pradeep, this question for you. I mean, even the rupee has touched recently the 20-month high against the dollar. So what can foreign investors expect in the near term in the currency markets?
Right. Okay, so things are always uncertain and can swing around quite sharply in the matter of days. So the rupee was on the stronger side 2 days back, and now it's at 75 rupees to the dollar. But our prognosis really seems to be, back of the envelope calculations, suggests that we will not have either a very large balance of payments deficit or a very large balance of payments surplus, as best as we can guess. And given that, the general determinant of our currency level is likely to be more the external environment, whether the dollar is trading strong or weak, whether it's a risk on or risk off kind of environment, etc. At this point of time, I would tend to think that the current rupee is going to be reasonably range bound around current levels. But I think clearly there are risk factors, and the topmost one to my mind right now is this kind of phase we are in, where there is potential for very volatile energy and commodity prices, specifically energy, and that has implications for us for sure on a balance of payments perspective. But it has a huge sentimental impact, not only for Indian markets, but for global markets, as we have seen over the last few days. And to my mind, it's one of the topmost risks if we have, an extended phase of extremely high energy prices. So if that happens, I would think the rupee will weaken. But if it doesn't really work out too badly, then I'm going to say that the rupee is going to be reasonably range bound
That's quite helpful. We will now move on to the most exciting section of today's webinar, which is market developments and a peek into the future. So, Pranjul, we've discussed that vaccinations on the rise, restrictions are being lifted throughout the country. Which sectors, specifically in your opinion, will see a quicker turnaround and more investment activity? And at the same time, which sectors, according to you, will take a little bit more time to basically rebound?
Yeah, so I think through the last 18 months, I think the sectors that have remained resilient have been government capex, exports, and agriculture. Government capex was a concerted effort by the government that, all the money they earned because of formalization, big companies got bigger and the big companies paid taxes. So government saw a huge increase in taxes, particularly this year. They use that money more towards capex than for current expenditure. So public capex was one thing, and I think now that has started off as a trend, and that is something that's going to continue, public capex being strong. The second is exports. Global recovery was strong, particularly at the start of the year. It has slowed a little bit. I think the Delta variant has played havoc, across the world. But whenever we come out of this, hopefully sooner rather than later, then exports could remain buoyant for a little longer. And agriculture, monsoons thankfully have been decent for the last couple of years. Agricultural incomes have generally been strong, and I think that will provide some sort of, sort of a solid base. Not really rising, but not falling either. So these three factors, I think, will continue to remain strong, and they have already been in the last 18 months. I think where the pickup could come is high-touch services. The fact that vaccination rates are rising, people will be going up and about much more. Travel, transportation, tourism, hotels, restaurants, all of these sectors that have been down in the dumps for the last 18 months, could get a shot in the arm, literally, with the vaccination. So I think that's something to look forward to. With a little more sort of longer term focus, I think some of the high skill manufacturing sectors could do well, particularly the sectors in which the government has some schemes, for example, the production linked incentive schemes. And, they range from, EV parts, electric vehicle parts, to electronics, a little bit in batteries. And, some of these new sort of high skill exports, that manufacturing can remain buoyant and can pick up, selectively. The final one would be private capex, and I think that would be the last to pick up. It generally is the last to pick up. The private investors need a lot of assurance that the demand that they're seeing rising is here to stay, and only then they take up risky ventures, which have a 2 to 3 year gestation period. And I think that will need more hard work. That's not coming very easily. For one, I think it will need policy certainty. We see that private investment in India is very sensitive to policy certainty. Uniformity, lack of changes in tax rates, keeping them as stable as possible. These are sort of good sort of indicators. Also, public capex tends to crowd in private capex over time. So that's going to be the second indicator. But eventually, it's going to be all about demand. If demand is not just pent-up demand coming out of a pandemic, but something which lasts for longer, only then will a private investor want to take up more investment activity. So that's probably going to be the last area of growth that will really rise.
Okay. Yeah. Thanks, Pranjul, for that. And speaking about policy and stability of policy, Ravi saw the next question, which is on top of every foreign investor's mind, which is, what are your thoughts on the merits of introducing a T+1 settlement on an optional basis by SEBI? And given that this is an extremely significant change, which will have a wide-ranging impact on the market, how equipped do you think we as India, the market infrastructure, is to ready to deal with this change, sir?
To be very frank, I don't want to really question whether the T+1 is good or whatever. So SEBI has issued the circular that the markets could move to T+1 on an optional basis. So to that extent, we are putting in place the infrastructure which is required to move to T+1, while the SEBI circular specifically states by January 1st we could go live. So we are putting in place, India is an interoperable, clearing corporations are interoperable. So to that extent, even if one exchange offers T+1, then our clearing corporation should be able to provide the services to ensure that we are able to clear on T+1 basis. So to that extent, we are working to create the basic infrastructure which is required to handle the T+1 settlement as seamlessly as possible. So to that extent, that effort is going on. While this is happening, we are also engaging with the foreign institutional investors as well as local institutions, retail. So series of conversations which are happening at this stage. We already are aware of FPI's reservations about the speed at which it is. I don't think anybody is questioning whether we should move to T+1 or not, but the speed at which it is expected to be implemented is causing most of the jitters. But we think we will be able to manage this in a way that would give comfort to the FPIs. So we are engaging even today with all the major foreign portfolio investors as well as associations. And we have given the comfort that we will possibly not be moving on our own to T+1 until we see the entire value chain is fully ready to and equipped to handle T+1. Having said that, we are working with the local institutions, local retail brokerages, the entire value chain again. And we are kind of trying to figure out how exactly the transition could happen with the least possible pain. That's where we are, and I'm sure we'll be able to find a solution which is acceptable to everyone.
So that is indeed really reassuring. So thanks for that, Pradeep sir. We move on to Pradeep sir, and the question here now is on bond. I mean, can you please give us some color on the activity levels that you're seeing in the market yields in 2021? And of course, there is news of potential inclusion of India in the global bond indices. What would be the anticipated impact of this inclusion, sir?
Okay, so just to give you a bit of a idea on bond activity level from the foreign portfolio investors. Of significance is that if I look back to the last 3 years, 2019 was a marginal inflow where they bought a little bit over $1 billion worth of bonds. 2020 was the big one where, as the pandemic broke, they sold off about close to $8 billion worth of bonds. And this year, we are seeing constructive inflows in the last couple of months, which is about $1.5 billion, which I would think is partly on the back of this chatter, which, as you mentioned, of possible bond inclusion being imminent, right? So, how imminent or not, I guess we will wait and find out. But just in terms of the impact and what one can expect out of it, we lean a little bit on the experience of the last major country to get included in the bond index, and that was China. So it took about 2.5 to 3 years from the time China started attempting to get included and taking action to ensure they met the criteria before they actually got included. And I think it has been a couple of years for India as well. So from a timeline perspective, we are almost there. The other thing is that if we look at an inclusion, typically we are looking at possibly two indices. One is the Barclays one is JP Morgan. And if we get it in both, right, then we estimate that with the weightages we get, it would lead to an inflow of about $30 to $35 billion. Now, before one gets too excited about it, the China experience shows that there is when inclusion is announced, it is effective a little bit later. Like China, I think, had a 6 months waiting period before it kicked in. And that is primarily to allow investors to kind of, get ready and prepare for this. And after that, it is phased in typically. So whatever your weightage, if for example, you're going to get a 10%, I'm just throwing a number, then for China, it was phased in over 20 months. So you would basically get 0.5% per month. So basically, the entire inflow could happen over a little bit more than a year and a half, right? So $30 billion over 18 months is not overwhelming at all from the kind of flows we have regularly seen. That's one. On the other hand, you will perhaps see some money from investor community coming in anticipation of this, real money coming in as index inclusion rolls out. So that is the second one to look at. But all said and done, I think if we get this kind of inflow from inclusion, then we would have FPI holding about 6% of our outstanding government debt, rather than about 2 to 2.5% where we are today. So that's a reasonable impact, and a 30 to 35 billion number is roughly about a fifth of annual government borrowing program right now. So it is a reasonable number, and I would therefore think that while it doesn't cause us to get overly excited in the short term, but it is definitely real flow, which is more than welcome in the medium term.
That's good to know. Since the Q&A is buzzing, the chat section, we'll just go quickly to the the last section for the panel discussion. So Pranjul, very quickly, what should be our policy roadmap for the future to make up the cost of the economy of the COVID crisis, and what should we be doing to get us back into the growth trajectory?
Yeah, so look, I'm tracking 4 things. So you said make it quick, I'm going to make it quick. I'm tracking 4 things. Number 1, I'm tracking disinvestments, privatization, asset monetization, all of these schemes by which the government wants to sell stakes in companies it owns, or sell companies it owns, or sell assets it owns, use that money to create new assets and get into a virtuous cycle of asset recycling. So I'm going to look at that. I'm going to see if these come through. Huge announcements have been made even in the past, and they've mostly disappointed in the past. Is it going to be different this time around? So disinvestment, I'm going to track that, number 1. Number 2, I'm going to track the insolvency and bankruptcy code, how it sort of progresses. It's probably the only mechanism we have in India to resolve the buildup of bad loans at banks, something which may happen a couple of years, once we're out of the pandemic. Generally, NPA buildup takes a few years to show up, and then we should have the right mechanism to deal with it. So how it really progresses is the second thing I'm going to track. The third thing I'm going to track is how the government continues with social welfare spending. There's a rural unemployment guarantee scheme, NREGA, cash transfer scheme, PM Kisan, because that's the only way in which the incomes of the bottom of the pyramid are supported. So the government should not really retract from that very quickly. And the fourth thing I want to track is, this whole protectionist tendency that the government sometimes gets into, with the whole argument of infant industry protection. They start increasing import tariffs on a lot of goods, which I think eventually does more harm than good. It keeps industry uncompetitive for longer. There is a slight sense that the government may have fallen into that tendency last couple of years. I'll be watching if it snaps back from it. Many of the countries who have actually been big exporters have opened up fully, and then they've been able to be big exporters. You can't have import tariffs and be a big exporter, because you just increase your cost of production in the economy, and then you're not competitive in the export market. So hoping that the government doesn't muddle up import substitution and export promotion. Instead, it only focuses on export promotion. So these 4 things.
Thanks, Pranjul, for making that quick. Ravi, so the question for you is in terms of the GIFT IFSC developments, and especially on the upcoming NSE SGX Connect for foreign portfolio investors. If you could just share what are the opportunities available in GIFT?
We have announced SGX, NSE IFSC SGX Connect some time back. Now it's by and large in the implementation phase. So SGX has already set up an SPV in the GIFT City. They've applied for our membership, and other technology and other areas are falling in place. So we have also started building the technology connect, both in terms of hardware and software. The work is happening on a war footing, and it should be open for testing towards the end of this year by the market participants. We're hoping that we'll be able to go live in the first calendar quarter of next year. So the work is in full swing, and we believe that will change fairly dramatically the way once we're able to shift the entire SGX Nifty volumes into GIFT City. That will give us the basis on which we will be able to build products around that, around the liquidity which comes there. So far, the presence of international investors has been very, very negligible, but that is going to change fairly dramatically. And the other good part which has happened over the last 1 year period, particularly from the time the regulator, unified regulator, has been set up in GIFT City. IFSC authority has been set up last October, and now there is a significant focus on building the GIFT City. Earlier, the focus was dissipated because multiple regulators were trying to regulate that area. SEBI looking at the markets, RBI looking at the banking, IRDA looking at the insurance side. With IFSC authority as a single regulator for GIFT City, things are changing fairly dramatically, and the regulatory facilitation has increased, and they are pretty open to changes which are required to make IFSC competitive in the international markets. So we see a significantly expanded product portfolio. We're also looking at a couple of products which will bring in Indian high net worth individuals into GIFT City. So we've just announced a DR program for international stocks in GIFT City about a month back, and we will be going live in the next 2 to 4 weeks. So that is one exciting opportunity for Indian investors to use their LRS route to reach out. Plus, our international bullion exchange is going to go live again between 2 to 4 weeks from now onwards. Again, India has always been a huge importer of gold, and we never were the price setters, while we were always the price takers. This is going to dramatically change with the international bullion exchange in GIFT City, as well as our domestic bullion exchange is expected to come up in the next 2 to 3 months period. So all these events are going to change the way GIFT City works. The product portfolio is increasing. Right now, we trade derivatives. Going forward, we'll be able to offer even underlying products. Derivatives are available currently mostly on indices and single stocks, but we are expanding to introduce derivative contracts on a variety of commodities. And there is one more exciting area which is really helping us kick up the GIFT City experience is the primary listings which have started to happen there. A lot of international foreign currency bonds and masala bonds are getting listed in GIFT City. A few of them in the last 2 months, we would have listed 3 to 4 new completely primary issuances out there. That is really helping us establish GIFT as an exciting opportunity for international investors as well as local investors.
Yeah, I'll just hold on to you, Ravi sir, for there are a lot of questions on T+1 that are available in the chat. One is, what is the impact of T+1 on derivatives and SLB? 2 is the market ready to deliver and implement T+1 so quickly? And what about the local FX markets being ready to support liquidity for T+1 setup? So I've just clubbed all these 3 together. If you could just give a view on T+1, sir.
So as I said, our infrastructure, market infrastructure would be in place. We are working on a war footing, and we'll ensure that the market infrastructure is ready and to support any exchange to move to T+1. While the timeline given by SEBI is really tight, but as I said, we are engaging with the entire ecosystem to try and figure out the best way forward. It is an enabling environment which SEBI has created. It is not as if we have to go live with T+1 on Jan 1st. SEBI has enabled the environment. It is not a mandatory kind of a scenario. So we will work with the ecosystem to ensure that we will roll it out in such a way that we take into consideration issues which are coming from various quarters, particularly FPIs. Because of the time zone issues, FX markets close around 5 o'clock. There may not be too much of liquidity post 3:30, 4 o'clock. There are multiple issues. So we are actually trying to figure out the best way to implement this so that international investors who are operating from different time zones would not be inconvenienced. So even if we move to T+1, which is still under debate, since it's a voluntary thing, we are still looking at various options. My only, at this stage, what I would want to give assurance to the market is we will give sufficient time to the market to prepare to go to T+1. As I said earlier, I don't think in principle people are against T+1. What is required is sufficient timelines so that people can prepare their entire infrastructure, and also ensure that the payment systems, and particularly the FX conversion, the trade confirmations, the entire flow from the time order is given till the time the money moves and a settlement is done, needs to be done in such a way that it helps investors sitting in various time zones to be able to stick to this without too much of a difficulty. We will do that, and we are reasonably confident that we will come out with a solution which is acceptable to everybody.
Really heartening to hear, sir. Pranjal, there's a question for you, very topical. What is your expectation on the RBI monetary policy review tomorrow?
Yeah, so I think it's going to be a tight balancing act for the RBI. On the one hand, it's really helped support growth recovery in the last year or so, and it doesn't want to take off that support in a big rush and spoil everything it's done. But on the other hand, you have a situation in which liquidity is so loose, inflationary pressures are building, especially with the recent rise in energy prices, which I think have still not gotten fully reflected into inflation and could happen in the next couple of months. So the RBI has to basically get that that fine balancing act. My sense is that tomorrow they won't touch interest rates, as in they won't bother raising the reverse repo rate yet. Some people are thinking they will, but my sense is that they'll wait for a bit longer before they increase the reverse repo rate. Instead, they will take some steps on draining out the excess liquidity that's in the system. Two things I think that could happen. One is that they had this bond buying program they used to announce at the start of every quarter. It was called the GSAP program. They could suspend that. Instead, over time, they will buy as and when needed with the operation twist. But the GSAP program is something they could suspend for now. The other thing is that they could increase the number of VRRRs, the variable rate reverse repo auctions. It's already about 6 trillion rupees. They could increase it further over time. They could also increase the tenor of that from 714 days to 28 days. So all of this on the liquidity front. So I think they'll focus on the liquidity front in a way that effective rates rise, but they won't really change the reverse repo rate or the repo rate yet. I think reverse repo rate hike is something that could come over the December and February policy meeting, not in tomorrow's policy meeting.
Okay, we'll just wait and watch. This is tomorrow. So yeah, thanks, Pranjal. Pradeep, there's an interesting question for you actually. This is on oil inflation and basically US taper. What impact do you see? Will it be a dampener or no?
No crystal ball. So don't know whether it will or it won't. But to my mind, this is not the base case, but I think it is a non-negligible risk that one should keep in mind. There are a couple of things. One is that the world, where India, but the world is coming off a very extended period where central banks have struggled to get inflation up to their target, right? And that has now made them take a stance where they said that they're increasingly tolerant of higher inflation for a period, because we are going to use what is an average inflation model, where a period of subpar inflation could be compensated by a period of above target inflation. So that is one. And the other on energy prices is that we are somewhere, in a cusp of this climate change driven agenda, where the world wants to move from traditional energy sources to clean energy sources. And as a result, there has been a recent period where perhaps there has been under investment or under production on some of the traditional sources. And we are not yet there to have a complete substitution. And as we get out of the pandemic, the third thing is the pandemic. It is a very unusual kind of event that we have gone through and which we are coming out of. And sometimes you just cannot figure out all the impacts that can come out of such a scenario. So, one could easily have a period of above normal demand coupled with below normal supply just because of not having full supply from traditional energy sources, and central banks being a little slow to react to an inflationary kind of scenario. And the big risk is that all of that would come together where at some point of time central banks just have to play catch up, and that can be a reasonably disruptive, along with, of course, what I did mention earlier, the extremely disruptive in practice and in sentiment, the impact of extremely high energy prices. So it's just something I have at the back of my mind. And while one really can't, crystal ball gaze and say this will happen or this won't happen, but it's something that I think one needs to watch out for, while otherwise going, with a nice scenario, because possibly by coming out of the pandemic and things are going to, normalize and look up from here in terms of activity levels and growth rates and all of that. So hopefully the base case will be rosy, but I think just bear this possible case in mind.
Okay. So there are two questions for Ravi. One is someone's congratulating you, sir, that NSE is now, again, for the second time in a row, largest derivative exchange in the world. What are the key enablers for this achievement? And there's also a follow-up question that what would be the impact to the SLB market, with something like a T+1 settlement affecting the SLB flows? Yeah.
Thanks for, the reason why we were able to be the number one exchange, derivatives exchange in secondary running is essentially the market. We create the infrastructure and the market has to take it up. And then some of the products which we have introduced, market has found them very, very useful, particularly the shorter duration contracts which we have introduced in Bank Nifty as well as Nifty have been taken up exceedingly well, both by the institutional investors as well as by the retail investors. We will continue to bring in products which make sense to the investors for them to kind of trade, hedge, and manage their portfolio effectively. That will continue to happen. There are a series of single stock products which are coming in. The numbers are going up slowly. We're also looking at a couple of indices which will help the market to manage their exposure far more efficiently. So we are on the lookout for products which make sense to the investors. That has always been the way NSE has worked. As regards, what's the third question you mentioned?
SLB and T+1.
Okay. Yeah, SLB obviously is going to play a fairly significant role. We'll have to figure this one out in terms of when the payout happen in case of a T+1 kind of scenario. So some of the details are being worked out from the time of confirmation of the trade till the pay-in, and where exactly we fit the SLB. SLB market has done exceedingly well till last year. There was a small change in the GST framework applicability for SLB, which has created a bit of a confusion. The volumes have dried up, but we think that issue will be sorted out pretty soon. Having said that, for T+1, we will be tweaking the SLB operations in such a way that it will be useful for market to use SLB as a mechanism in case of issues they face in case of their trades not going through or derivatives positions. So those issues are being worked out, and I'm sure we'll be able to come out with a product set of product specs which are very useful to the market.
Good to hear. A question for you, Pranjul. How do we see that the bad bank actually helping in reducing bad debt from bank balance sheets? This is something that you'd mentioned earlier. So if you could just throw a little light on that.
Yeah, I think the number one benefit of having a bad bank kind of a institution is that it frees up space in the bank balance sheet, and the bankers can then focus on giving new loans rather than worrying about what's stuck in its balance sheet. So it frees up space, both literally and also mind space in the bank balance sheet. But the big challenge is once the bad loan has been parked with the bad bank, what's going to happen to it? And that's where the big questions are. Will this bad bank be able to get the right professionals, have the right incentive structure that actually leads to the resolution of these loans over time? Or will it simply become a warehousing place? Because, some of the past experience, pre-2014 kind of experience was that at points ARCs used to buy the bad loans, but for a management fee was simply just warehousing them. And that is a situation we don't want to get into. A lot of the details are getting worked out. We are waiting for it. But I'm hoping that there is a good incentive structure that incentivizes, the professionals to actually resolve the bad loans rather than just warehouse them.
Thank you, Pranjal. This has indeed been a fascinating session today. We are unfortunately running out of time. So we'd like to conclude by thanking our panelists for sharing your insight and expertise, really indeed valuable. And we also thank our attendees for taking time out. We hope you found this session useful. It has given you some food for thought on India at 75. Stay safe and stay happy. Please take care.
Thank you.
Thank you.
Bye.
Bye-bye.